Hello and welcome to your Daily Five. This is Erin Swenlin from decisionpoint.com, and I am here to show you the five charts that I think are the most important going into this week. And let's just go ahead and get that started right now. Okay, so I do a DP trading room on Mondays. It is free. I would love to see you there. It's a great way for you to learn short-term trading, and you can sign up for that on my website. You'll see this ad right here. Just click on it and it will get you registered. All right, so today I want to talk about the state of the market. We had State of the Union, so let's talk about the state of the market. I'm going to start off with the S&P 500 here. This is the 1-year daily chart. It has a lot of great information on it. And the first thing I want to point out is, of course, we know we're in a declining trend. Carl and I here at Decision Point believe we are in a bear market. We know that we haven't hit that magical 20% down yet in the S&P 500, but we certainly have on the Nasdaq and the Nasdaq 100, and we're seeing the same kind of deterioration continuing. So we believe that this is a bear market, and honestly, I think our indicators bear that out. So first of all, most of the indicators you're familiar with, but the RSI you can see has been negative below 50. We have the PMO, my price momentum oscillator, measures the momentum similar to the MACD PPO. And the problem I see here is we have a top beneath the signal line, and that is especially bearish when you see that. So we're seeing not only price deterioration, we're seeing negative RSIs, and we have a lot of high total volume as well as a lot of volatility. So between those two things, three things, four things, I would be looking for the market to continue lower in the short term for certain, and then we'll more than likely see it fall in the intermediate term. And I'm going to show you some charts that will explain that. But one other thing here, you can see stochastics is turned down before even reaching 80. And we like to see it above 80. When it's oscillating above 80, the market or whatever the index stock you're looking at usually is moving upward. So we're seeing that tip over even before we hit that level of 80. So of course, seeing a VIX in the 30s is also a problem, and we invert our VIX. You can see that the VIX is hovering here, oscillating below its moving average on this inverted scale, and that implies internal weakness, but I don't think that's a surprise to anybody here. Let's look at the intermediate term oscillators, because like I said, I want to talk about the fact that I believe that this market is in a bear market. It's a bear market. So let's talk a little bit about some of the intermediate term indicators. So these are the intermediate term breadth momentum indicator and volume momentum indicators. And one of the things I'm finding very interesting on these charts is that we are starting to see these indicators contracting out of oversold territory. So of course, hey, this is a good thing. We're starting to see something that is, positive, bullish on the chart. But then you look at price, and you see that it is in a negative divergence, really, with what's going on these indicators. And that is a problem. So if price is not confirming these indicators, there's something wrong under the surface. We look at how many buy signals we have, crossover buy signals, and you can see that we are just slightly above 50%, which isn't that unhealthy, but we're still seeing the market moving lower. More than likely, with the S&P 500 having more large caps in it, that could be part of the issue. That's why we're seeing the S&P 500 acting the way it is. Large caps are not doing as well, performing as well as the small and mid caps. Let's get on, though, with the participation of using our golden and silver cross indexes. So I'll explain these indicators a little bit more for you. So first of all, these are the easier ones to get a grip on. So this tells us how many of the S&P 500 stocks are above their 20-day EMA, above their 50 and above their 200 day. So that tells us where price is for each stock, right? We know that at this point, 45%, less than half of them, have price above their 20-day EMA. I don't know about you, but I'm not interested in stocks that are trading below their 20-day EMA. So that tells me that I have less than a 50-50 chance now of getting a good stock, more than likely. Now we're looking at the S&P 500 above the 50-day EMA. That's getting worse. We're seeing 39% there. And then above the 200-day, we now have less than half of the stocks in the S&P 500 with price above their 200-day EMA. This is a serious problem. This tells you that there are real problems under the foundation. But let's put that all together using the Silver Cross and Golden Cross indexes. So the Silver Cross index measures how many of those stocks in the S&P 500 have a 20-day EMA that is above the 50-day EMA. So we know that it is on a silver cross, is what we call that, a 20 above the 50. Right now in the S&P 500, only 35% have a 20-day EMA, green one, above the purple 50. Not a surprise, honestly, when you look at what's going on with the S&P 500. It's certainly below its 20-day EMA. It's below its 50. The 20 is below its 50. So, of course, you know, the index, a lot of the stocks within it are doing similarly. And that's why we're seeing these low numbers on the Silver Cross. The next one is the Golden Cross Index, and you can see this measures how many stocks have their 50-day EMA above their 200-day EMA. Right now, we do have 62%. But as you can see, when you look at this one-year chart, these are very, very low numbers. Now, I will tell you that we have seen much lower readings on all of these during the 2020 bear market. So don't get too comfortable here. They may look oversold, but as we often talk about with bear market rules, oversold conditions are thin ice. They don't usually provide great foundation when you're in a bear market or when your stock is in a bear market. Let's go ahead and we'll pop on over to crude oil. But as you can see on that other chart, we've got some serious problems with the momentum in the S&P 500. We have price deterioration based on participation and that golden and silver cross. So bear market, we are in one. Prepare for lower prices. Crude oil, let's just flip the coin to the other side here. Crude oil is absolutely going through the roof for obvious reasons with the Russia-Ukraine war that is going on currently. Of course, that is upsetting the price of oil because both of those countries produce quite a bit of oil, and scarcity, of course, leads to higher prices. So when you look at the USO chart, you can see that it doesn't track exactly to West Texas crude. That's why we include West Texas crude under here too. The ETF tracks futures. So you can see that we have the gap back here from 2020, and we've been waiting for that gap to be covered. It has now been covered. Typically, when you get the gaps to be covered, and you're going in the direction that covers the gap, you're going to see a sustained move past that gap. So we cover the gap, and then we normally are going to see some follow through on that. We got the big time follow through last week, and it's just continuing higher. Prices are going to continue higher. I know that people have talked about $200 a barrel. That is pretty high. I don't think it's out of the question. I think we're going to have to suffer through this in order to, make help with our supplies, but also, really put the pinch on Russia right now, which is what we need to be doing. You can see that the PMO is moving higher. It is certainly on the overbought side at 12, but you can see that when it went to the downside here, it hit 30. So that tells me that as far as the range for the PMO, it normally runs between like 5 and -5. But now, because of what's going on, our our scale is such that with the lows, it was at 30. So now I'm looking at a PMO at 30 to be considered overbought at this point, which is absolutely insane to think about. You can see West Texas crude just really kicking into high gear here. This is a weekly chart, by the way. I forgot to mention that. I wanted to give you a really good sense of where we are. Let's look at gold, and we're going to look at its weekly chart as well. And I did say it was GLD. This is dollar gold. I apologize. So as you can see, gold is also becoming a beneficiary of what is going on. You know, typically you're going to see a lot of concern there. And this is your safe haven. So you can see that we've broken out. We still have 2100 to reach as overhead resistance, given this PMO moving higher. Given that the correlation with the dollar now is positive, I think we're going to see both the dollar and gold continue to rise. And you can see that PMO on the weekly chart suggesting that could continue as well. That is pretty much it. I am Erin again, Swenlin from decisionpoint.com. Check us out. I have that coupon code for a free 1-week trial. And that is it for your Daily 5. Thanks so much for watching.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.